Hello everybody and welcome back to another video. First things first, this is not financial advice, never will be. This is opinion only content. I know nothing about the markets. I'm strictly sharing opinions and data. Make of that what you will. With that understood and out of the way, I wanted to dive into this whole conversation about Richard Newton's GME model being broken. He made a post yesterday on X stating essentially that poking fun of it and saying all models are wrong. Now, if you have no idea what I'm talking about and you don't know who Richard Newton is, the high and the low, the inside baseball, if you will, is essentially that he was a daily contributor to the GameStop stock community. And he had built an online model that was pretty accurate in predicting price with the input data of fails to deliver, swaps, and ETF creation and redemption cycles. With those inputs understood, and if you don't know what any of those things are, that's fine. We can do more educational stuff on that another day. But Richard Newton's model is currently being updated by somebody from Superstonk, and it is now a officially published sheet. So you can see here that this was Richard Newton's best model, and the red line is the expected price of GameStop with those inputs that I said, and the blue line below is the actual price. So in for I'd say you can say however many months this tracked really well, but it was pretty accurate for long periods of time. I think it really gained credibility in the time around the first bond offering last year. And you could start to see that, the red price, the expected rundown from January to February, March, April, then the bond offering, and then it really catapulted up, which matched GME's price really well. So this model, and I want to share a few thoughts, and this is more of an informal setting, and I'll show you some really cool data in a minute here, but I don't think that this model's broken. I think that he simply missed a swap that was very hard to see in this area. Now, if you're just looking at this for the first time and you say, well, the red line is going down, that's true. But this is a pretty steep and sharp sell-off in a quick amount of time. Now, I'm going to pull up my personal chart. I took inspiration from Richard Newton with his swap theory. I have my own kind of markers I look for as well that are similar but a little different to Richard Newton's. And you can see that this price action here is what everybody is obviously thinking is a swap. I said this to my ex subscribers in a video a few weeks ago that this extended sell off after a really strong earnings report, and correct me if you've heard that before, stop me if you've heard that before with GameStop, but a beat of $72 million, an earnings per share surprise of 32%, and all while the stock, just a few weeks later is being completely slammed down. Now, the general market, you could say, well, the general market had some down days too, but, realistically, if you look at a similar span in early October, SPY's flat. Okay. I mean, there was some little downside, which to the tune of, 2% on SPY. Again, so it's not like there was a significant market correction or anything that would have explained a macro extended sell-off specifically for GME. So none of the China tariff trade war talks would do this on GME. It's clearly a swap, and you don't need to be a Wall Street guru, a super insider, master trader to understand that. And this is not, before the TA crowd comes in and says, oh, this is a retest, and those are all good, and I like TA as well, but this is clearly market mechanics here above all else. Now, my personal model, which is obviously not financial advice, I have us coming up for the Fed interest rate decision and October 29th, which I believe is National Cat Day. I do not do hype dates. I just think that if there was any sign of Roaring Kitty on one of his multiple monikers and online alias accounts, it could be on that day coincidentally. But if you're looking specifically at it fails to deliver, we have two interesting T plus 33 days here around the first week of November. I think that's when you could see some price action and some reasoning there. If you look at the earnings report, September 9, you go out 33 trading days. you're going to start to enter this window here. Now, other big FTDs around this time, if you go out 33 trading days, you're going to be right around November 5th. So, what do I mean? What am I looking at? Well, let's start with IWM. They had, starting on September 17th, massive, massive fails. It continues on. It persists. It persists. It persists. This is an indication that there is a problem. And for anyone that says, well, IWM doesn't hold GME, there's no possible way that they could be failing GME through IWM. Let's just take the 2 seconds to ask perplexity. Yes, IWM fails to deliver can still be indirectly linked to GameStop, even though IWM no longer holds GME. That's interesting. The connection arises through market structure and ETF creation and redemption process rather than direct share ownership. Essentially, this is legacy, hedging, and exposure. At one point, GME was in IWM, and market makers that once used GME shares in ETF creation and redemption through baskets, even after IWM dropped them, derivative swaps and short positions can still persist in IWM, leading to synthetic exposures. So I typically like to look at IWM, even if it's a smaller amount, or if it, in this case, is a massive amount of fails, you can tell that something is not right. Something is wrong. Now, XRT, obviously, as well, another one that we'll look at with fails. This is also very indicative that something was wrong. You can see a massive spike here. 126 million on 9/15. And of course, these are all right around GameStop earnings, of course, popping in and around those dates. So I'm not looking at these specific fail dates with a Hawkeye lens necessarily, as much as I'm looking for a couple other things like borrow rate. You can see, oh my gosh, wow, XRT just skyrocketed today. So you can see that there's some anomalies going on, and that's usually a period of a swap or high shorting. In this case, I wanted to show you guys, I put a purple swap on my chart here, ending in one of these days, October 23 through maybe the 27th or 30th-ish, which of course lines up perfectly with FOMC. Nice little narrative there. But if you look back, and this is a potentially something that Richard Newton, or the person actually that we should be crediting, was on Superstonk that came up with this theory. By the way, I forget their account name. They actually came up with it. Richard Newton ran with it. Credit to Richard Newton for making it so publicized. But if you look at the same period of time, year over year, so maybe this is a 1 year swap roll, potentially in the middle of other swap rolls as well, which lines up perfectly, you can see very similar price action at this exact time last year. You had, a quick little rise in price, 20-ish%, big drop in price, down 15-ish%, and then a massive rip up to the tune of 70% to the upside. Now, if we go back another year, late October, you can see aggressive shorting. You can see a decent earnings report here. You get a little pop, a little bit of run into it, aggressive shorting. And this one was great because this one, they brought it all the way down. They had to really let pressure off. This was a big pop, 56, 57% to the upside before ultimately a huge slam down. And the rest was history when Roaring Kitty came back. But you can keep going back, look into October. Now, this one I think is highly notable and very, very interesting. I wanted to share with everybody. This was in 2022, and you can see kind of similarities of, oh, we got earnings. Ooh, big 25% rip up. All right, good report, decent report, right? Immediately slam back down, 20% down into late October on the same exact day, the 23rd and 24th, deep low. They settled this one out real quick. Massive 45% rip to the upside. And you can say, oh, there could be company news, or it could be this, that, and the other. But highly interesting that on a year over year cadence, you get something that looks like a gigantic swap right around this time. So the 6-month theory on these other swaps looks pretty good still. I have them on my chart. And then you can see kind of my expected price action here. From a combo of Richard Newton's models, FTDs, and sort of my own narrative with FOMC being baked in. Now, how can you say for sure that this is happening? You can't. And from what I understand about can kicking and the rules that persist therein and of, you could potentially theoretically kick this can through more ETF FTD juggling, creation and redemption, and kick this whole thing out if you wanted to have a repeated and agonizing downturn, similar to kind of here, where from December to April, you just got straight down pretty much, besides, a couple pops here and there. And these were big pops, but for the most part, you got extended downturns. So, could that happen? Sure. And that's why I think Richard Newton poking fun at all models are wrong is kind of perfectly emblematic of the fact that this is not for sure. And that's why I personally, I'm not playing calls on this anymore. I think it's far too risky. Shares, if you really have a good pop and you feel comfortable selling covered calls, that is a completely different story. And I don't want to hear that hurts price and this. You'd have to be a massive whale for that to be really impacting anything. But that's one way that I personally would consider doing something like this. Now, in the event that Ryan Cohen and the company issue news and they add a significant, quarter after quarter revenue generating business through M&A that really impacts the balance sheet, well, then throw this whole thing out, throw this entire model out. I think that's why, Ryan Cohen coming on an interview recently and is saying to the effect of, the time is not right, we are waiting with our cash, is highly, highly notable and interesting. Another factor I personally like to look at and try and bake into when there could be better price action, specifically pertaining to GameStop, and this must be taken with a grain of salt, but there is some data to back this up, is CAT errors. Now, the Consolidated Audit Trail System essentially tracks market errors, trades, and options both. You can see, coincidentally, late September 29, 115 million trade errors, not options. We'll get to the options in a minute. Why is that date in particular appealing? Well, that's right around the top on GameStop. And then you kind of have two little dojis there or hammers, and then just straight down. So did that stop something? Was there a link to those CAT errors? You had another big batch crop up on October 6th, which, let's look at that on the chart. Yeah, another interesting little moment there with another big push down right after that. So are there some strategic errors happening around that time that are linked to GameStop? Maybe. It's possible. More importantly, I wanted to show, and there's another one, 925, 359 million trade errors. So let's take a look there. And a down day for GameStop. I mean, it's definitely notable. I don't want to say it's a for sure link, but the options errors specifically, this is options. You can see the industry aggregate trade data for options on October 1, 1.19 billion options errors. Why is that so interesting? That is really the last green day for GameStop before the swap. So, could it be related? Maybe. I'm going to show you the data now from Region Formal, one of the kind of only DD writers left, or data writers left on Superstock, which is a whole nother sad topic we can get into another day. But they essentially just tracked the correlation between CAT errors and then improvements within GameStop's price from both 35 calendar days out and 70 calendar days out from these errors. That is when they officially have to be taken care of. You can see there is straight up green, all plus signs across the board. Now you have some very small ones, like December 14th of 2022, only a 1% move off that. You have others, 1.8 billion on the 25th, in May of 2025, 33% move up. So, these are all relative, but you can see in the data that there is some price improvement. Now, of course, we had a Roaring Kitty event here May 1st of 2024 when there were 7.2 billion errors, led to a 500% increase in price. Obviously, you had Gamma, you had an options environment that went crazy from that. You had Roaring Kitty back himself. You had massive trades coming in. You had dealer hedging. You had TD and Schwab merging, which is a legacy forced closure of fails to deliver that are kicking around in the system. So you had a lot of factors, but this is interesting as well. So is Richard Newton's model broken? I absolutely do not think so. I did want to close this video out showing the new model that um, this person on Reddit, I think their name is MC Connoisseur or something like that. I'll have to get their official name, but their model has been updated to take into some new considerations here and shows what their expected price action is. And it actually hits this little downturn perfectly with their new inputs. So you can see here, and this again, this is off of Richard Newton's first model. So change the inputs a little bit. Look at this downtrend you get here. And then all of a sudden you kind of hit the bottom late October, right? There's October 24th. There is FOMC, and that kind of begins the sharp move up. Now they have it peaking on November 11th. So let's go over to our options environment and take a look at the max pain for that week, which would be no 14th. They have it at 20 bucks. So, you know, you can kind of see, and they have $25 on November 7th. So on my chart, I personally have November 6th as the peak from these, we'll just call them shenanigans, broad strokes, and don't want to accuse anyone of crime here, but let me know in the comments what you think about that. So that would be my theory. So Richard Newton's model, it just needs a few more inputs. Could he have missed a purple swap? Absolutely. Could they have, you know, kicked this swap roll another month out? The red swap, maybe. It's totally possible. The tracking of swaps within databases is, you need to be a like super high tier computer programmer to make sense of these datas. There have been people on Reddit that have tried to make sense of it and done a decent job. But to keep things a little bit higher level today, 35,000 plus foot view, this is what I'm personally expecting, which is not financial advice. I do not think that Richard Newton's model is broken. And the fact that we're even all sitting here talking about this model on GameStop specifically, I think is a very good sign that retail has kind of smartened up to these backdoor behind the scenes games that Wall Street is playing. And if you don't care about any of this, if you're not a tinfoil, and if you think this is tinfoil, even though it's quite frankly just data, if you don't subscribe to any of these beliefs, the bottom line is that Ryan Cohen is turning this business around. And you can look at the last few quarterly reports and you can see signs of improvement. And I think that is ultimately what's going to move the needle in the long term for this company, is the continued profitability, the continued growth, hopefully, in revenue, and continuing to add revenue streams in like power packs and other things that are synonymous with the collectibles and gaming brand that are ultimately going to get this stock to where Ryan Cohen wants it to be for himself, because he's a massive shareholder, and then for all of us, which are loyal, all in, speaking for myself, shareholders as well. So that's my thoughts. Let me know what you guys think in the comments below. I hope you're enjoying the videos, and I'll talk to you again real soon.